Welcome to Victor Daniel. I'm your host, Victor Daniel. And before we dive into today's analysis, I need you to do something. If you value honest economic reporting that cuts through political spin, hit that subscribe button right now. Like this video, share it with anyone who needs to understand what's happening to California's economy, and leave a comment below with your perspective. Your support keeps this channel going. Now let's talk about something that should terrify every Californian. On January 2nd, 2024, Chevron Corporation filed an SEC Form 8K that sent shockwaves through California's political establishment. The company announced it would write down between $3.5 billion and $4 billion in assets. But here's the critical part. $2.324 billion was specifically attributed to California's regulatory environment. That's not a typo. $2.3 billion declared essentially worthless because California's policies made them unprofitable to operate. The filing stated bluntly, quote, "The company will be impairing a portion of its U.S. upstream assets, primarily in California, due to continuing regulatory challenges in the state that have resulted in lower anticipated future investment levels in its business plans." Translation: California's regulations have destroyed the value of our assets. We're writing them off, and we're not investing another dollar in this state. Chevron's production in California has dropped 15% since the COVID-19 pandemic and now accounts for just 3% of its worldwide output. The company said it expects to continue operating the impacted assets for many years to come. But that's corporate speak for we're milking these assets until they're completely worthless, then we're gone. This wasn't just a financial maneuver. This was Chevron declaring war on California's political establishment, and Governor Newsom had no response because the write-off exposed exactly what his policies have done: made California toxic for energy investment. What regulations specifically caused this massive write-down? Start with Assembly Bill 1167, passed in October 2023 and effective January 1st, 2024. This law requires operators to post a bond for the estimated total costs associated with plugging and abandonment, decommissioning, and site restoration prior to acquiring marginal or idle wells in the state. Nearly all of Chevron's wells in California are marginal or idle. The passage of AB 1167 means Chevron can no longer offload its upstream decommissioning costs, known as asset retirement obligations, to smaller oil companies. That's the industry playbook. Big companies sell depleted wells to smaller operators and avoid cleanup costs. California just made that impossible. In its 2023 Form 10K, filed February 26, 2024, Chevron disclosed an upward revision of its asset retirement obligations in the amount of $1.7 billion. Their decommissioning costs are much higher than previously estimated. According to the filing, Chevron's increased asset retirement obligations primarily reflect increased cost estimates and scope changes to decommission wells, equipment, and facilities. The $1.7 billion asset retirement obligation write-up accounts for 73% of Chevron's total $2.324 billion California asset write-down. Greg Rogers, an expert in accounting for upstream asset retirement obligations, confirmed higher expected costs and shorter asset lives could require upward revisions to prior estimates. Translation: California just forced Chevron to recognize that their wells are worth way less than previously thought because the costs to properly decommission them are astronomical, and they can't dump those costs on smaller companies anymore. But AB 1167 wasn't the only regulation. California's low-carbon fuel standard forces refiners to buy carbon credits based on the volume of carbon-emitting fuels they supply. The state's cap-and-trade program forces refiners to bid for emissions allowances, Governor Newsom signed multiple laws in 2023 targeting the oil industry, then announced the state was suing Chevron, Exxon, Shell, ConocoPhillips, BP, and the American Petroleum Institute for decades of deception about climate change. Chevron looked at the regulatory landscape and determined their California assets were functionally worthless. So they wrote off $2.3 billion and stopped investing. The hidden message. California wells are stranded assets. Frac Tracker Alliance analyzed Chevron's SEC filings and concluded that the company was hoping to offload its idle wells to limited liability companies to avoid the cost of properly decommissioning them. Assembly Bill 1167 destroyed that strategy. Chevron's wells in California are now stranded assets. They produce oil, but the regulatory costs and decommissioning obligations make them unprofitable long term. The company can operate them for a few more years. Extract whatever value remains, then walk away. But there's no future investment, no expansion, no growth. California production has declined from representing a significant portion of Chevron's portfolio to just 3% of worldwide output. That's a death spiral. As production declines, per barrel costs increase. As costs increase, profitability drops. As profitability drops, investment disappears. As investment disappears, production declines further. Chevron isn't fighting to save California operations anymore. They're managing the decline until it's time to shut everything down and leave. Exxon followed with its own massive write-off. 2 days after Chevron's announcement, ExxonMobil dropped its own bombshell. The company announced billions of dollars in impairment charges, blaming California's regulatory regime for rendering assets worthless. Exxon's write-off centered on the Santa Ynez unit, which consists of 3 offshore platforms near Santa Barbara County. California's environmental regulations made further development economically impossible. Exxon decided the assets had no future value and wrote them off. Combined, Chevron and Exxon wrote off approximately $6 billion in California assets in 1 week. That's not a coincidence. That's 2 of the world's largest oil companies simultaneously declaring that California's regulatory environment has destroyed the value of their investments. The message to other energy companies was clear. Don't invest in California. The state will regulate you out of existence, then sue you for operating there in the first place. The Chevron-California relationship collapses. Chevron's relationship with California has turned increasingly adversarial. The company disputed the state's climate change claims in the lawsuit. They reduced investments in refineries. Then, on August 2, 2024, Chevron announced they were relocating their corporate headquarters from San Ramon, California to Houston, Texas. CEO Mike Wirth said, quote, "We believe California has a number of policies that raise costs, that hurt consumers, that discourage investment, and ultimately we think that's not good for the economy in California and for consumers." Andy Walls, Chevron's president of America's Products, explained, quote, "California is a tough place to have a big employee base. The cost of living is expensive, and we were not able to get employees that didn't live there to move there. And that's not sustainable for us, to be honest. This is Standard Oil of California, the company that built California's oil industry from nothing, the company that operated in the state for 145 years. And they're walking away because California made it impossible to stay. California officials tried to downplay the headquarters move, calling it the logical culmination of a process that had been ongoing for years. But the $2.3 billion write-off 6 months earlier told the real story. Chevron had already declared California operations essentially worthless. Moving headquarters to Texas was just the final step, the Richmond refinery. Next, on the chopping block, Chevron operates 2 refineries in California, Richmond and El Segundo. The Richmond refinery processes 256,000 barrels per day and fuels 1 in 5 vehicles in Northern California. It supplies 60% of jet fuel used at Bay Area airports and 100% of the lubricating base oils on the West Coast. But Andy Walls warned in an interview, quote, "I'm not going to tell you that's the death knell, but we're getting close. If I can't invest there and I can't get a return, we will move on." That statement came in response to Richmond's proposed per-barrel tax, which voters rejected in November 2024 after Chevron negotiated a deal to pay $550 million over 10 years. But the message was clear. Chevron is evaluating whether to close both California refineries. Richmond provides 24% of the city's general fund revenue. Chevron paid $58,850,877 in taxes, utilities, and settlement payments during the 2024 to 2025 fiscal year. Under the recently approved agreement, Chevron will pay an additional $50 million annually for the next 5 years, and $60 million annually for the following 5 years. If Chevron closes Richmond, the city loses over a third of its revenue overnight. Benicia city manager Mario Giuliani warned his city could face a situation similar to Vallejo's post-Mare Island Naval Shipyard closure, which sent that city into bankruptcy. Richmond would face the same fate, and Chevron has already declared California assets worth $2.3 billion essentially worthless. Closing the refineries is no longer an if, it's a when. The national security implications. Chevron's write-off has implications beyond gas prices and jobs. California hosts more than 30 military bases that rely on state fuel production. Air Force and Army installations depend on refineries for jet fuel, diesel, and gasoline. Representative Vince Fong warned, quote, "These refineries make jet fuel and diesel and gasoline for our military. Bases in Nevada and Arizona are also reliant on our production." When Chevron writes off $2.3 billion in California assets and stops investing, military fuel supply becomes vulnerable. If Richmond and El Segundo refineries close, West Coast military bases lose access to reliable domestic fuel supplies. Assemblymember Stan Ellis expressed concern that California already imports about 20% of its refined petroleum products from India. That share could double if Chevron closes refineries. He warned that global instability could jeopardize those supply lines. Imagine a military crisis requiring rapid deployment from West Coast bases, but fuel supplies depend on tankers from India and South Korea taking 40 days to arrive. That's a national security nightmare. And Chevron's write-off shows the company has no intention of maintaining California operations long-term. The foreign oil windfall. Chevron and ExxonMobil both argued that California's regulations won't reduce oil consumption. They'll just shift production and profits to foreign producers like Saudi Arabia, Russia, and China. California currently imports 75% of its crude oil. After the Phillips 66 and Valero refinery closures, gasoline imports could reach 50% in Northern California. Those imports arrive on tankers from Asia, burning heavy fuel oil that emits 50% more carbon dioxide per barrel mile than pipelines. So California's environmental regulations aren't reducing emissions, they're outsourcing them. California shut down domestic production and refining, then imported fuel from countries with worse environmental standards, higher emissions, and zero accountability. Chevron's $2.3 billion write-off reflects this reality. The company determined that California's policies make domestic production unprofitable while creating massive opportunities for foreign competitors. Why invest in California when Saudi Arabia, UAE, and other OPEC nations will gladly fill the supply gap? The California Independent Petroleum Association warned that Senate Bill 1137, which prohibits new oil and gas wells within 3,200 feet of homes, schools, and hospitals, threatens the jobs of more than 50,000 residents and would result in more foreign-produced oil coming to the state's refineries. Rock Zierman, CEO of the association, said local oil companies desire to restart production and contribute to the state's economy. It is strong among our member companies, as demonstrated by the 1,400 permit applications for new wells that sit unreviewed at the state. California blocked domestic production, then complained when companies stopped investing. Chevron's $2.3 billion write-off was the inevitable result. What the write-off really means: when a company writes down assets, it's declaring them worth less than previously thought. Chevron looked at its California wells, calculated the regulatory costs, decommissioning obligations, and future investment requirements, and determined the assets were worth $2.3 billion less than their books showed. That's not a temporary adjustment. That's a permanent declaration that California operations have no future. The company doesn't expect to recover that value. They're not planning investments to improve profitability. They're managing decline. Chevron will continue operating California assets for many years to come, but that's a timeline measured in years, not decades. The company will extract remaining value, meet existing obligations, then close operations when they become unprofitable. There's no long-term plan because California's regulatory environment makes long-term planning impossible. The write-off also sends a signal to investors. Chevron is telling Wall Street that California operations are declining assets that won't generate returns. The company is redirecting capital to Texas, the Gulf Coast, and international operations where regulatory environments support profitability. For California, that means no new refineries, no refinery expansions, no significant investments in existing facilities. The state's refining capacity will continue shrinking as facilities age and companies decide they're not worth upgrading. The jobs and economic impact. Chevron employs thousands of workers in California across refineries, oil fields, corporate offices, and retail operations. The $2.3 billion write-off signals those jobs are at risk. When companies write down assets, they often follow with restructuring, layoffs, and eventual closures. Chevron hasn't announced mass layoffs yet, but the trajectory is clear. California operations are declining. Investment is stopping. Eventually, employment follows. The Richmond refinery employs over 1,200 workers directly and supports thousands more through contractors, vendors, and local businesses. If Chevron closes Richmond, those jobs disappear. El Segundo refinery employs similar numbers. Combined, potential closures could eliminate 5,000 plus direct jobs and 10,000 plus indirect jobs throughout California's economy, and those are good-paying jobs. Refinery workers earn salaries that support families, buy homes, and contribute to local economies. When those jobs vanish, entire communities suffer. Tax revenue collapses, businesses close, housing markets soften. The economic ripple effects last for years. Benicia, Richmond, and other refinery communities are already watching this happen. Phillips 66 closed Los Angeles. Valero is closing Benicia and Wilmington. The Marathon closed Martinez. Each closure devastates a community. Chevron's write-off suggests Richmond and El Segundo are next. Governor Newsom's non-response. After Chevron announced the $2.3 billion write-off, Governor Newsom's office had no substantive response. They couldn't defend the regulations that caused it. They couldn't deny that California's policies destroyed asset value. They couldn't promise the situation would improve. Instead, Newsom continued pushing the same policies that drove Chevron to write off billions. He signed more environmental regulations. He continued the lawsuit against oil companies. He blamed price gouging for high gas prices while regulatory costs made California the most expensive state to operate refineries. The $2.3 billion write-off exposed Newsom's contradictions. He claims to support working families while implementing policies that eliminate their jobs. He claims to care about gas prices while regulating refineries out of existence. He claims to fight climate change while forcing California to import fuel on dirty tankers from Asia. Chevron's write-off was a corporate declaration that California's policies don't work, and Newsom had no response because defending those policies is impossible when the results speak for themselves. What comes next? Chevron declared $2.3 billion in California assets essentially worthless in January 2024. They moved headquarters to Texas on August 2024. They've stopped investing in California operations. The timeline to closure is shrinking. Richmond and El Segundo refineries will likely follow Phillips 66 and Valero out the door. The question isn't if, but when. Chevron will operate them as long as they're marginally profitable, then close them when costs exceed revenue. California drivers will face gas prices above $8 per gallon by 2026. Northern California will depend on imports for 50% of gasoline supply. Military bases will lose access to reliable domestic fuel. Thousands of jobs will disappear. Communities will face budget crises. And it all started with a $2.3 billion write-off that exposed California's energy policies as economic suicide. Chevron looked at California's regulatory environment and decided their assets had no future value. That's the most damning indictment possible of Governor Newsom's leadership. If this analysis opened your eyes, subscribe to Victor Daniel right now. Comment below with your thoughts on California's energy crisis. Share this video with everyone who needs to understand what's really happening. The collapse has already begun, and the question that remains is whether anyone in Sacramento is willing to admit it. Thank you for watching Victor Daniel.